Datavault AI Inc. is currently trading at $1 USD, representing a massive intraday jump of 52.63% as of Friday, January 2, 2026. This is not just a standard price fluctuation, it is a violent upward move that has caught the broader market off guard, especially considering the stock was languishing near the 0.65 level just days ago. While many retail traders are looking at this percentage gain and thinking they missed the boat, the real story is much more complex and involves a highly specific corporate catalyst that most passive observers have completely overlooked. The expectation among the general trading public is that this is a simple meme stock rally or a low float pump, but the reality is rooted in a looming January 7th record date for a dual distribution of warrants and digital assets. This creates a unique pressure cooker for short sellers and a ticking clock for anyone wanting to participate in what the company is calling a special dividend. If you're looking at the current action on your Fidelity mobile app or tracking the ticker on the Robinhood app, you might be tempted to think this is just noise. But the common ground here is that Datavault AI, under the ticker DVLT, has been a difficult stock to hold for the last year, dropping significantly from its highs. The general belief is that the company is burning through cash and struggling to monetize its intellectual property. However, I want to challenge that narrative by looking at the specific mechanics of this warrant dividend. The company is offering one warrant for every 60 shares held, but there's a catch that most people haven't read in the fine print. To actually exercise these warrants, which have a strike price of $5 USD, holders must also possess a specific digital token in a Datavault wallet. This is a move to force users into their ecosystem, turning a financial instrument into a tool for platform adoption. It is a high-stakes gamble on user engagement that most institutional investors usually avoid, yet the price action today suggests that someone is buying up shares to secure their spot on that January 7th record date. The volume today is staggering, with over 214 million shares changing hands, which is far beyond its typical daily average. This suggests heavy institutional reshuffling or a massive short covering event triggered by the dividend announcement. When you see this kind of activity on interactive brokers' trading platforms, it usually means that reality of the situation is shifting faster than the expectation can keep up. Most investors expect a microcap like this to just fade away, but the management is actively using corporate actions to defend the stock price. We have seen similar tactics in the past with other small-cap tech firms, but the inclusion of a Dream Bowl meme coin as part of the dividend structure adds a layer of digital asset integration that is relatively rare for a NASDAQ-listed company. It's essentially a bridge between traditional equity and the world of crypto, and whether you like it or not, it is driving the 52% surge we're seeing right now. Now, before we get deeper into the financials, I want to hear from you. Comment below how many shares of Datavault AI you currently hold, or if you are planning to trade this volatility before the record date next week. I'm curious to see if the community is actually buying into the digital asset strategy, or if you're just here for the quick swing trade. Looking at the broader market context, Datavault AI is operating in a space that is increasingly crowded. While big names like NVIDIA stock or Apple stock dominate the AI headlines, companies like DVLT are trying to carve out a niche in data valuation and monetization. They claim to have a platform that can put a specific dollar value on datasets, which is a massive need for companies trying to train their own large language models. The expectation is that AI companies will just scrape the web for free, but the reality is high-quality, verified data is becoming a scarce resource. Datavault's Information Data Exchange, or IDE, is meant to be the marketplace for this. If they can successfully prove that their acoustic science and data science divisions can generate recurring revenue, the current $1 USD price point might actually look cheap in retrospect. However, that is a very big if. The recent financial reports for the quarter ending September 2025 showed revenue of about 2.9 million USD. While that was a 148% increase year over year, the net loss was over $32 million. This is the classic struggle for small-cap tech. They are growing fast, but the cost of that growth is astronomical. They have a negative net margin that would make most value investors run for the hills. Yet the management recently raised their 2026 revenue guidance to an ambitious $200 million. When a company with $3 million in quarterly revenue says they will do $200 million in a year, you have to look at where that money is coming from. They are banking heavily on licensing deals, specifically a $10 million agreement with Silex Holding Company to tokenize genomic and therapeutic data. This is where the expectation of a tech failure meets the reality of high-stakes licensing. If those licenses don't materialize, the guidance will be a major point of failure for the stock. The company itself, formerly known as WiSA Technologies, has pivoted several times. Originally focused on wireless audio, they have now rebranded to focus on the proof economy. They use blockchain and AI to create digital twins of assets, whether that's a piece of medical data or a sports highlight. Their technology suite is designed to handle the secure monetization of these assets. They have a division for spatial sound and a division for data science, which is an odd pairing, but they claim the underlying math for sound transmission and data valuation is similar. This business model is complex, and complexity often leads to a valuation discount because investors don't understand how the company actually makes a profit. If you're doing self-investing or using investing sites to research this, you'll find that the sentiment is highly polarized. Some see a pioneer in Web 3.0 data management, others see a company throwing everything at the wall to see what sticks. Institutional activity has been a mixed bag. We saw Silex Holding Company take a massive stake, which provided some much-needed capital, but we've also seen some insider selling over the last few months. When the CEO or CFO starts unloading shares, even in small amounts, it tends to dampen the buy-and-hold narrative. However, the recent appointment of a high-profile legal team suggests they are getting ready to aggressively defend their patents. This is a common strategy for companies that have valuable IP but struggle with direct product sales. They turn into patent tigers that generate revenue through litigation or forced licensing. If you're using a Fidelity brokerage account or Interactive Brokers platform to watch the order flow on DVLT, you'll notice that the bid-ask spread can be quite wide, reflecting the uncertainty and the high risk associated with this kind of play. Macroeconomic pressures are a factor too. With interest rates still being a major talking point for the 2026 market, small-cap companies that are not yet profitable are the first to get squeezed. They don't have the cash reserves of a Tesla stock to weather a long downturn. Datavault AI had only about $1.68 million in cash as of their last report, though they have since announced financing rounds. This lack of liquidity is likely why they are using warrants and digital tokens as dividends. It allows them to reward shareholders without actually parting with the cash they need to keep the lights on. It's a creative solution, but it's also a sign of a company that is backed into a corner financially. The future outlook for Datavault AI depends almost entirely on the execution of their 2026 guidance. If they can actually hit that $200 million revenue mark, we're not looking at a $1 stock, we're looking at something much higher. But the risk of a miss is extreme. We have a few catalysts coming up. The January 7th record date, their exhibition at CES 2026, and the upcoming Dream Bowl All-Star Game where they will be showcasing their tokenized autograph technology. These events will provide the reality check that investors need. If the technology fails to impress or if the warrant distribution turns into a logistical mess, the stock will likely retreat to its previous lows. On the other hand, if they can prove that their data valuation model works on a large scale, they might finally gain the credibility they've been chasing since the rebranding. In summary, the current 52% jump to $1 USD is a classic example of a market reacting to a short-term reality that contradicts a long-term expectation of failure. The warrant dividend has created a localized demand for the shares that is divorced from the company's current lack of profitability. The expectation was that DVLT would remain a sub-dollar penny stock, but the reality is that management is pulling every lever available to them to stay relevant and drive the price up. Whether this is a sustainable move or just a temporary spike before a massive sell-off remains to be seen. You have a company with explosive revenue growth guidance but massive net losses, a complex business model that spans from wireless audio to genomic data tokenization, and a corporate strategy that is heavily reliant on the adoption of their own digital wallet. For those of you using online investing tools or a Robinhood investments account, the volatility here is a double-edged sword. It offers the potential for massive gains, as we saw today, but it comes with the risk of total capital loss if the 2026 revenue targets prove to be a fantasy. The central insight here is that Datavault AI is no longer just a tech company. It is a laboratory for new types of corporate actions and digital asset integration. The contrast between their ambitious $200 million goal and their $3 million